Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, December 13th, 2023. It's 12:43 p.m. Eastern Time as I'm starting the video. So we have about an hour and 15 minutes or so before the I don't want to say much anticipated because this one wasn't. I usually say, when there's a everything's hanging on what the Fed's going to do. I call that a highly anticipated meeting. This one's going to be the as far as what they do, which is hold rates, that'll be a non-event. Obviously, it's all about what they say. If anything, maybe it'll be a non-event as well. But we'll see. Let's just, I always say this: don't read too much into the initial reaction on a Fed announcement. And what I mean by that, you're going to be watching your 1-minute charts, or if you're an active trader in front of a computer like me, you see an initial sharp rip or dip in the markets. That initial rip is honestly, I've never seen it not faded. Now, whether that's the lasting one, the one that sticks, is yet to be seen. But usually, you see something like this, and then ultimately the market will pick its direction. Again, don't read anything about the 2 p.m. reaction. It's going to be more important when Powell comes on, does his press conference at 2:30. And then even then, you still have plenty of stuff on the economic calendar this week. And I think at this point, the market has stopped listening to Powell. The market is pricing in what it thinks is going to happen, and that's rate cuts this year. And so, he may, say something to either confirm or maybe somewhat squash that idea to an extent. We'll see. Again, I'm not reading too much into or trying to anticipate too much into what they say. Important thing here, I'm going to go over the charts. I'm going to cover not just the markets, but I will start there, QQQ and SPY, also do an update on the VIX very briefly, and then some other things, crude, natural gas, wheat. It's been a while, I wanted to update orange juice. That was a trade thrown out, short trade idea recently. And then bonds, and then the euro. Let me write that on my notepad here. So we'll hit the big three. Sounds like a lot, but let me say this. Yesterday, I posted a video here on the site, and just today checking, and it looks like in some of the comments, this one didn't go out by email. So there's a software that I've been, way back when I'm installed on the site that works in conjunction with when a post is published, it fires off or triggers something that sends that post over to the MailChimp servers. MailChimp is the biggest email marketing. You have to use that if you're sending out bulk emails, or they just get flagged as spam. And so it's the conduit between there. And every once in a blue moon, the trigger doesn't fire. If I'm around, if I'm trading actively, which I haven't been, this is Fed week. Volume was nil yesterday. I'll talk on that in a minute. But I'll often catch that, or I'll come into the comment section. But I didn't see that till today. So where I'm going with this, I'm going to give you a link to that one, or I'll try to do that in this post when I publish this video. If you don't see it there, if I forget to do it, just come into the site. As I recommend every now and then, there's always a lot of great questions in the comment section, and other trade ideas, others share, or other perspectives. And so I encourage you to come in from time to time and check. But there it is. And this one, I just want to say I covered some things, some of the things I have covered recently, but I also expanded on that. And let me just give you as I did in this update here. In a nutshell, the bottom line is that we recently had these PPO sell signals, and that was, again, in addition to the low volume sell signal I had a couple weeks ago. But we had the S&P 500, the NASDAQ 100 triggering, and then the VIX volatility index also triggering a buy signal on the PPO with that. And what I did in this video is I went over the history of it. And the takeaway, again, as I said here, it has what I'll say is a damn good track record, not a perfect track record, but a pretty darn good one. And by really deep diving into this, as I said in that video and showed you, it appears if it's going to happen, if this is going to prove to be another good sell signal, identifying a significant trend change, i.e. pullback and market correction, leg down, whatever you want to call it, and a spike up in the VIX, based again on the history, and there are no guarantees here, if it's going to happen, it's going to need to happen soon, and most likely this week. So here we are on Wednesday. Obviously the Fed could be a catalyst, or it's going to prove to be a whipsaw signal. Like I said, I wish I could tell you that this or any indicator out there was 100% effective. Obviously, if it was, we wouldn't need to work. Everyone would just use it and make tons and tons of money. So all I can do is look at indicators that have a high rate of effectiveness, especially in current market conditions. That's something else I do when I analyze charts like this. If something worked great 5 years ago and it worked for a decade or more, and then it stopped working, you really kind of stop using that indicator. So I always put a higher weighting, is it working or has it been working in the current market conditions that we're in? So again, I encourage you to read that video or watch that video. And as always, remember guys, when you watch the videos, if you just click here on the settings, you can increase the playback speed. I do it on just about every YouTube video I watch.
Tuesday, December 12th, 2023.
Whatever it is.
Let's take a look at three different. Start with the VIX volatility index, and then
certain instances. Let me stop this video. I'm sorry, I hit that and it started playing. But that's it. That's how you increase the playback speed. I usually find 1.5 to 1.75 is what I like. And of course you can always loop back if there's something, hey, I wanted to catch that, stop, turn it back on to normal and go back in there. All right. Market update. Not to spend a lot on there because I've covered this a lot lately and not much has changed going all the way back into September, mid-September. Highlighted, two scenarios, both of them taking us the same end game, the same end result. And so big move lower. And one of them just had us saying that was going to be the top in the NASDAQ 100. And my alternative scenario, which again still had us going to the same longer term targets, just had us doing exactly this first, a marginal new high. So again, it's all lining up. Either these sell signals that I've had recently will trigger or they won't. And the one thing I've told you lately that's been lacking, at least for me, is any really clean sell signals via breaks of support, such as price or trend line. So I'm going to give you those levels to watch again this week. And, and remember, the flip side of it holds true. If these support levels don't break, if they hold, they get tested, or you just have a post-Fed whipsaw and you get back above them, then that's bullish. Support holds. We have a breakout, at least in QQQ, not the rest of the market. This is the S&P, I think, just took out that previous high. So we have those marginal new highs. So that scenario, again, that I've had for months now is still very much in play. Obviously, once an alternative scenario comes into play, then it's then the primary scenario at that point in time, obviously. And this is, again, not... Just to be very clear, they all, and I said it back then, I made it repeatedly said, it's the same thing. Short term, we're talking a relatively small move based on those long-term targets, again, on the weekly chart. This is a weekly chart. Weekly divergences still very much intact, just like you had heading up to those highs. I covered some similarities between the recent price action right here and the recent price action leading up to the top back then. And you have, as I started to get to a second ago, I'm putting them right here. What I do have now are some decent uptrend lines you can see on QQQ. This is a daily chart. You have 4 candles there, several right there as well. So those are the trend lines there on QQQ. 60-minute chart looks like this. That's the same trend line there. That's just an alternative trend line. So you have these big wedges, exactly like you had heading up into the highs in November 2021. And that's it. And so there you have the two big levels to me would be this uptrend line right here, this one off the recent lows. That's the mid-October or late October lows right there. That's the trend line I just drew on the daily. And then, of course, if we fall back above, that's the breakout. Right here was the breakout to new highs. Not all time. Remember, we're still below the 2021 highs in the NASDAQ and in the early 2022 highs and everything else, the S&P included. We're just talking this July high. But with that being said, it's a very significant, we had the biggest correction we had in all year off that high. So bottom line is this, if it sticks, we have another successful back test, even if it's a slight pierce down through there, I'm going to tell you this right now. Instead of this being the magic number right here, because that's the previous high, this is still the level right here. T1. It was my first price target. It was hit. We bounced. It's that big old gap. That's the level where I think if we fall back down here, trying to use an arrow tool, forgive me there. I think that'll do the trick and open the door for that deeper downside, because it will also, you get down below there and it'll help solidify that this whole thing here was a failed breakout or false breakout. Okay, as I often talk about, usually when a security or an index breaks out to new highs, number one, especially when you're overbought with divergences, you almost always get a back test. And most often you do, especially again when you're very overbought with divergences. And it's not a perfect back test. Usually they'll do this to kind of shake out a little, the suck in some shorts that think the breakout failed just because it went below that previous high. And that's what happened right there, actually. And also maybe scare out some weak-handed longs. So I always allow a little room on a back test of a breakout. And so that's, again, why we already had that. That happened right here. So those are the levels I'm looking at, guys, and trade it as you want. In the way I would look at it, if I had 0 short positions, that's where I'd be adding shorts or initiating shorts. In my case, I'm short now. I have some shorts. I'm going home short. I've been mild short for a while. They're not going anywhere. I have other things that are offsetting that, but lately it's just been a suck wind month for me. I had that. I'm going to get to second natural gas, but I'm back in that now. Crude I didn't take before, but I'm in that now. I don't think I had a position in crude in the last month. Let me try to. I trade so much. No, I don't believe I had crude, but I do now. And I'm going to show you the charts there. And there's a little micro trend line. Look at that right there. So that you could zoom down, drop it down to a 15 or a 5-minute chart, and you'll see that. And so that could bring in some selling today if taken out. Okay, bottom line, divergences, negative divergence, 60-minute out, daily chart, all the way out here to the weekly chart. And heck, if I'm not mistaken, yes, even on the the monthly, technically speaking, you look at QQQ, you have to at least have an equal high there. You're almost there. For all intents and purposes, you have it. And that's rare. You rarely get big negative divergence on monthly charts of an index. And when you do, that's like long-term stuff. And again, it meshes with what I'm seeing. It's just a matter of we going up a little more before we go down. And, still have these, even on the monthly charts, some pretty aggressive longer-term downside targets. So we'll see. We'll see if that's going to happen today or anytime soon. And this is the daily chart here. Remember back on this correction off the July highs, we hit T1, T2, in which case posted covering shorts, reversing because all the fangs and QQQ, everything was at support. And so this is really, and again, expecting and anticipating that a decent chance of that marginal new high. Still, you can consider it the same trade, although we closed it out there and bounced it long. But the targets are the same. So T3, T4, T5, and these are intermediate term swing targets. So I'm trying to differentiate time frames. Short term is my 60-minute chart. I have those targets I gave you here recently. Off this divergent high, we hit T1, we bounced, marginal new high, T2, T3, T4 be a back test of the trend line. And then again, longer term charts there, targets, on the daily, and the longest term targets that I laid out just when this bear market started getting going. And we hit T3 right there and bounced off T3, and this is T4 down here. So that's a long way to go. And right now, sentiment is about as bullish as I've seen it in a long time. So we'll see where things go. Oh, yeah, let me show you that. All right, it's funny. I meant to show you this the other day. A couple times I forgot. I just haven't updated the AI bull-bear spread in a while. This is a chart I've had for years on here. And what this one does is it shows the AAII bull-bear spread. For those of you not familiar, it's the American Association of Individual Investors. They do a weekly survey to all their participants, whether they're bullish or bearish on the markets. And it's one I give a little bit of a grain of salt to because it's a what I call a sentiment survey and rhetoric versus positioning. In other words, I like the put to call ratios better. They're kind of a no man's land right now. And on all of these, whether it's the put to call ratios, the equity only, the total put to call ratio, the index only put to call ratio, I only give weighting or find any predictive value when they're at extremes. Same with this one. So again, this one, it's
Animals.
had to pause it there for a second. Okay, so yeah, I'd like to look at these extremes. So this is the highest extreme right here, and I've labeled that years ago. The red zone, I call it. It shows extreme readings of the spread between bullish and bearish market participants as per the AAII sentiment survey again. So I don't look at, like some folks will, a high in the bullishness or a high in bearishness. I find the best use of this is to look at the differential between the two. And that's what this shows you. Again, the spread between bullish and bearish market participants. So you can see I have a dashed red line right here that usually does the trick. It's rare to get up to this zone, but when you do, let me center this chart for you and show you real quick. There we go. You can see down below, I kind of box in red, these are big corrections. This is the S&P 500 down here. This one's not shown red. That was COVID right there. It never even got up to that red line. But there it is. You can see we had a cluster of readings. When you have readings in close proximity, that's a cluster, and that was followed by the, what many consider the bear market, or what some like me consider the first leg down in the bear market, came after those extremes. Then right here, look at that. There's a dotted line. Nailed the top. We hit that, and it didn't even look back. That started the correction, which we traded down to the lows recently, covered at the lows. And this is the pop-up in the S&P, and I just wanted to point this out. There it is. We now have just recently hit that spike, that level again. And again, you can study this, go back in time. We hit it back here. We had that correction. All the big corrections, even going back, there's the last bear market we had in 2007 to 2009. We hit the same red line right here. And that coincided almost perfectly with the top. Then we had a bear market rally that came to that level. The big bear market rally before the final huge leg down in '08. It's pretty compelling stuff. I just wanted to bring that up because I meant to a few days ago or last week when I saw it hit, and I forgot to include it. Okay, quick update on the S&P 500 via SPY, the S&P tracking ETF. This right here, this is at marginal new high. Like I said, we're still below the highs from early 2022, right there. However, we do have clearly a higher high, and it's pretty steep. This isn't like you have to stare at it. Do we have negative divergence? These indicators are clearly lagging. I know I saw one side comment on there about the divergent highs, yet another divergent high. Hey guys, this is what I do. These divergences don't always play out for a trend change, but as I often say, more often than not they do. And again, divergences are not a timing indicator. They can build, on the weekly chart, they can build for months or even years, and they often do. That's the span, at least on a weekly chart. You're going to see them at least over months. Your daily 60-minute charts, those are different time frames, but there it is. I'm just going to show you. This is a weekly chart. It's pretty damn accurate. Again, you had divergence there. You had a correction. It's not as if the first divergent high didn't play out. It did, and there was a nice correction. The divergences only got bigger and extended. And so I'm just pointing out in the last decade or so, these were the divergent highs. There was one right there, very clear, unmistakable, 21% drop. Then we went up, the divergence, those same divergences, because from the same point right here to there, grew even larger, and then gave us a 36% drop, the one that came from COVID. So I've said this many times. I won't call it a black swan event. Sure, I'm going to call it a black swan event, but the technicals were pricing in a 36 plus, give or take percent drop in the markets when that happened. And we were short when that happened because of the technicals. So there was a trend line break right there. So, you can go back in time. This is the previous one, 2015, 2016 right there, which was what really called a deer market. We had two corrections, 15% back to back roughly. And then it was almost a year and a half of the, or more, it was close to 2 years of the S&P going sideways. So there's a situation where I'll say the divergences played out more so in the correction in time than in price. Although again, we got 2 double-digit drops, so it's not like they didn't play out at all. Early on in the bull market, this was after the last divergent high in 2007 right here, gave us a 57% drop in the markets right there, 56, 57. And then the first divergent high in the bull market was 22. So, like I say, you guys do what you do, I do what I do. I'm trying to hone down and pair up with these divergences, which I've been doing recently, including that video yesterday, some sell signals to give us, to let us know or let me know when it's time to start going aggressively short. Right now, the trend is clearly bullish. It's drifting up, and I'm just marking levels here. This is a daily chart of SPY right here with divergences as well. This is sloppy. Let me give you a cleaner board here, and I'll show you real quick. You can draw the divergence right there. This is the current divergence right there on SPY. That was that measured target too. Remember, I pointed out this head and shoulders back here. It had a beautiful neckline right there. It's textbook pattern. And I pointed out if you missed it, you had a back test of the neckline, and we hit the measured target literally to the penny. The measured target being the widest part of the head and shoulders pattern, and that's also again that was one of the reasons covering shorts back then and going long for the bounce. And again, in hindsight, I've said this quite a bit recently. I should have just stayed long until I had a very strong sell signal or reason to get short treasuries, which I just did recently. As I said early on in there too, as I said, it's going to be almost impossible with my bullish call on bonds to see the stock market go down if bonds keep rallying and rates keep falling. So, like I said, I'll get the next one, and I think the next one's going to be on the way down here soon. So there it is, guys. That's the levels. There's the bigger divergence that shows on the weekly. 60-minute chart of SPY. That's a busy board here. This one here, divergent high, and there it is. Lift that little divergence up. There's that near-term trend line. Again, this is just a 60-minute chart, but pretty clear divergence. And I know the market seems optimistic about this Fed meeting. I was optimistic about the last one, getting long bonds in front of it and long equities in front of it. And then the market wanted to wait till it was over. So I don't know. This one, I don't know. Again, I don't know if it'll be the Fed meeting, but I suspect there's going to be a catalyst to get this thing going. It could be the Fed. It could be some of the other reports that we have out this week or next. But all right, there's your updates. And the levels to watch, just like the Qs. Okay, second interruption in the video. Boy, I'm glad I don't do these things live video. I got a lot going on lately. Still, this is all Hurricane Ian repairs. Getting the last of it put back together. Just put in 2 new AC units yesterday, and the condensers, those big things that go outside, were pretty banged up. So they got new ones coming in. Just called me. They're going to put those in tomorrow. Alrighty, there it is. Divergent high, last previous high. There's your breakout. It's clear on SPY. You can see there it was a distinct boom, tested it, had some consolidation, broke out. So, as I like to say, a breakout on face value is bullish and forget about face value. A breakout's bullish unless it fails. So, this is what I'll be looking for. If we come back down solidly again down through there and really give it a little bit of a margin of error, let's see the S&P 500 again. If you want to have a little more higher degree of confidence, you want to see the S&P 500 or SPY take out that recent level of consolidation that comes in around 453, down somewhere around there, call it 452. And if that happens, then and again, no guarantees, but if it does, what I can guarantee it will be is a failed breakout. That's a breakout again over those previous highs, resistance, and so anything down below there. Can't guarantee that it's going to waterfall down. I think it will, not necessarily. It could waterfall, it could move down in an orderly fashion. There's a lot of red flags, or yellow flags, I should say, including volume lately. I just mentioned that to you earlier in the video, and you take a look at the volume here. Turn this up. These are my volume bars down below, especially on the Qs. Qs have been acting quirky yesterday. I pointed out to you 2 days ago, and I have not seen this, I don't think ever. almost all the 100 of the stocks in the NASDAQ 100 were up, but every single one, without an exception, all 7 of the FANGs were down, and they were mostly down big. They were mostly down over 2%. It's kind of weird. And it's, again, it just, you can say, oh, yeah, it's positive, Randy. It shows that the rest of the market's starting to pick up, and maybe they're, the big FANGs are overvalued. It's unusual. I've seen days where there's good market breadth overall, more advancers than decliners, which is what you want to see. That one just I don't know, it seems quirky. I've had these periods in the past. I remember in the flash crash, what was it, 2015? I'm trying to remember back. And there was a very similar slow, steady grind higher in the markets on very low volume, just like this. And then we had that flash crash come. And I remember noting it. And then there was some, pundit, some, floor trader, someone that came on that said the same thing. And they had seen that like back in, I think it was in 87 before the crash. Anywho, those are the levels to watch, guys. And here's what I wanted to show you. This is QQQ. There's today's volume. Today's Fed day, but if you look here, yesterday's volume was really, really low. If you draw a line, I'll do that for you. Put it where it's at. You can see it was one of the lowest volume days when you go across here, other than holidays. That was a holiday. There was Thanksgiving, the truncated day, and Thanksgiving week. But anywho, so this market's been drifting higher. And it reeks to me, I have little doubt in my head that most short sellers, and I can even see that from the comments on the site, have just given up and kind of resigned themselves to the fact the market's going to just go up. And guys, it may, like I said yesterday in that video, I cited one of many things that I could see, all these 5.5% money market and CD promo rates rolling off and money coming back into the market and blah, blah, blah. I go off the technicals. I can't sit here and try to forecast the economic reports and how the market's going to react to those, how the market's going to react to the Fed. So what I do is I react to the technicals. So I've given you the levels there, trend lines, and remember, I'm going to go segue over to bonds real quick, the big 3. Those same trend lines, and I gave them to you on a lot of the big market-leading Mag 7 stocks recently. You have these uptrend lines off that key low here in October. And so TLT, the 30-year bond, is right on there right now. I'm just going to show you the rest. IEF has already broken down and is currently back testing it the way I have it here. If there's a line, you can see IEF. And IEF is also has recently run into that primary downtrend line. That's why we shorted it there. So this is resistance on bonds, and you can look at the other ones, LQD, corporate bonds. They've already broke down below the comparable uptrend line. You can see that little kickback rally, but still below. JNK, I might have it marked on. Let me see if not. Yeah, there it is. Breakdown, back testing from below. And then what's the other one? HYG. So there's bonds. I have that in 2 variations on that trend line, both of which were below. And so that's kind of the common theme. So if we can get that trend line get taken out on the S&P 500 and any other, the Mag 7, or was it QQ? Yeah, it was QQQ, sorry. QQQ. And then I have the Mag 7 here. I'll have to tweak them. Remember, I had these trend lines are already broken. I'm going to add this one for Apple right there. Gives you a beautiful wedge right there on the daily. Microsoft, let's add a new trend line now because we already took out those first ones. Alphabet's already doing its own thing. It's grinding lower. It's grinding sideways, let's just say. All right, this big range right here. So it needs a break. And again, these purple lines, guys, this goes back to months ago. Like I said, that was the reason for covering shorts there. Tested the throttle, tested the red line on the tachometer with interest rates, with all these Mag 7 stocks, and they all, each and every one, held, either tested or remained above those purple lines. Microsoft, it was just a great time to cover shorts and go long. And it's still every bit. And I said this once before recently. I had those lines before we got there as very significant support levels. Those support levels were tested and held. Therefore, by that logic, it only stands to reason it is even more significant support now, because you have another, in not just a minor kind of obscure reaction, a very distinct reaction with a powerful bounce off those trend lines. So as important as I thought they were a few months ago, they're even more important right now. So if you want to just, hey, Randy, all right, I hear you. Yeah, see what the market can and can't do. This trading here is a big trading range. If we break below those trend lines, that's, to me, and I said it back then, that was my all-in moment. That's where I get aggressively short. It doesn't mean I put every penny I have into index shorts or short individual stocks. It's just where I have a high degree of confidence that the market's going to fall, and probably fall in a pretty, I'll call it a waterfall fashion. I think it'll be a pretty swift move down. But there they are, and they all held. Amazon, my purple lines were the uptrend line, which we hit to the button, along with, you can't see it because I covered it up, the 200-day simple moving average, bullish falling wedge, divergences. There it is. But we've come full circle, just like this divergent low and bounce off some key support levels was a catalyst for this rally. I see, technically the same reasons in reverse, or the same exact reasons we had right here to get short. Negative divergences that have built, and it gave us that ABC corrective wave right there. And there's NVIDIA. Again, hopefully you can see these levels here, purple lines right there. 375 is the lowermost line. Meta, the purple line's right here. I don't have a price. It's a 275. And then Tesla, I had them in blue. It should be all color-coded the same. There it is, about 198. Okay, in yesterday's video, I covered the VIX in details. This is the VIX right here. You have 60-minute chart. These are the January contracts right here. Big positive, aka bullish divergence. So I don't know. A lot of the technicals are still pointing to that correction I've been looking at for weeks now. It's just bigger. Guys, we had divergence here. I pointed out the VIX back then, having divergence. And what happened is the divergence is not only not been negated. By negated means you have to take out those previous lows, but it's grown even larger. And that indicates an even larger bounce now. So if you're trading VIX futures, I would say at least that 1588 minimum target right there, possibly quite a bit more. I've thrown out to you VXX. And again, I covered the actual VIX, which I encourage you, if you missed it, yesterday's video, which is still timely. It's not anything that's dated at this point. VIX futures, you don't look at it daily because there's so much decay on the way this thing just rolls these futures. You're going to lose money over time if you're sitting in it, but that's still T1. It was T1. I started highlighting back here. And again, the divergence has just gotten bigger and bigger since then, since that point. And of course, the VIX is not going to go up until the market goes down. So that's it. It all goes in together. And just keep that in mind. If you trade the VIX, two things to keep in mind. You're basically shorting the market. You're buying the VIX or VXX or any of the VIX tracking instruments. You're buying them. You're going long, but you're betting the market's going to drop. So if you are long the VIX and short QQQ or SPY, particularly SPY because it's the S&P 500 volatility index, it's an overlapping trade. And then also in VIX, you have to beta adjust your position size way down, because if this thing plays out, and I still maintain these targets I have from before, T5 is going to be a 75% gain. T5 is, and I put these little squiggles because it's roughly, because I need to align it with the actual spot VIX and the VIX futures. Because over time, again, this thing's just going to drift down. What I mean by that, here's a weekly chart of VXX. You put all your money in back here when COVID hit at the highs, you'd be down 99%. You'd have lost almost all your money. Even if you waited when the bear market started right here, back in 2022 in the beginning, you're still down if you held this sucker 80%. But the actual VIX itself, well, when the bear market started right here, the VIX is only trading 25% below that level, and could be back up there in a week based on how it goes. So you can see the VIX over time is kind of range bound, if you will. It's not a set range, but doesn't lose money. So just, again, important to note. you got to be, have your timing pretty good with those. So you want to wait, maybe wait till those breakdowns I just gave you, the failed breakouts in SPY and QQQ, if they happen. They may not happen, but if they do, and we take out those levels, not the previous highs, those levels below the recent consolidation in SPY and QQQ, then that might be a good time. All right, I promised you crude oil, USO for you ETN traders. And that divergence just continues to build. So we've been building divergence since back here on the 60-minute chart. We had divergent. Now, and look, these divergent lows played out. That was a divergent low right there. And we had a pop. Actually, that gave us that ABC move there. But it's just one large divergence, and it's really starting to steepen at this point in time. You can see, in other words, you can see the slope of the divergence line now going up right here. If you look at just this and this, that is a a bullish falling wedge pattern. There's your downtrend line. And then if you trade crude future, which I just took a starter today, just a small position, because these guys, crude, natural gas, just can't get out of their own way. But I'm going to go over, trading strategies with that in just a second when I get to nat gas. And it'll be the same for crude. And that is not to give it a lot of room. There's the previous lows. Natural gas, I'm doing the same with the previous natural gas trade where I put the stop a little bit below, because at this point I don't want to even see us get near that low. They're probably just going to continue the pattern, and usually when they take these previous lows out, there's just waterfall selling. You can see right there. So there was previous low and they took it out, boom. That's why I don't want my stop get caught up and run in there with everyone else's stops. But it's constructive, guys. That's it. That's all I can tell you. No guarantees. Positive divergence. Crude's certainly getting oversold, and looks like a pop. These are my targets. I did update these today. 72, 74, 76, 70-ish, 79.50 right there. 4 targets if you trade futures. Okay, and although they don't always move together, they've both been drifting down, and this is natural gas. So the last update, and this was kind of a pull demand kind of thing. Folks were asking me about this. I had just kind of put it off my radar, especially when it fell below that recent trading range. Remember, it had a trading range back here. But so someone asked, and I threw it out. Yeah, I said, when I covered a video, I said I'd give you 2 stops. And was it right here? Posted as a long on the breakout above 275, 276 right there. That breakout didn't stick, but I said I would recommend to keep stops tight. I had an uptrend line right here. That stop was taken out. That was a minimum, a very tight stop. And even this one was very tight. I said max stop right there. And I had that line, if you see a little bit actually below, you can't see it now. I'll zoom in tighter and you can see it maybe. I had that line set a little bit below the spike low because I didn't want to, again, be involved. I didn't want my stop loss orders sitting in line with all the others, because that's what I'm talking about when they take that out. So that was a well-placed stop. We lost, was such a relatively small gain, because again, you beta adjust a natural gas trade. What does that mean? You take a whole lot less than you're trading in SPY or Apple or QQQ, because the gain loss potential is many times in natural gas. So that was almost a break-even trade and minimal loss, and we got out in time. But however, I like it again. Positive divergence. I look at the volume on UNG. Here's UNG. Possible selling climax. Looks capitulatory here. You can see this surge. I think you can see them. Here's my volume bars. We have a lot of a big increase in volume right here, and that is indicative of a potential selling climax in natural gas. But either way, you have a positive divergence here on the 60-minute chart right there. I don't have a lot of targets. I would align those with the ones I gave you on natural gas, but there is a downtrend line right here. I'm using the wrong drawing tool here. I got to get rid of that squiggly line. You have a downtrend line, and then on UNG, a big old gap. And a lot of folks trade UNG, so that gap, you're not going to see it on nat gas futures. They trade around the clock, but that's certainly a logical target. It's right at, I have it at $4.99. We'll call that $5. And if hit, that's going to be about a 8% pop. But again, the takeaway here too is by definition, a selling climax is what the term implies. A climax, that's when something is finished. So, therefore, one strategy, if you're a long-term investor, would be if you get in, it starts to work its way up, raise your stops. Initially have a tight stop for the reason I said this thing is in an unmistakable downtrend. I call it the widowmaker. Just when you think natural gas can't go up anymore after it's been rallying hard every day or down anymore, it does. And it'll do it again the next day, and it'll do it again and again and again. So don't underestimate how overbought or how oversold natural gas can get. Take it from me. I traded a long time. That's why you got to manage stops on this one. As very important, as much as any other position, of course. But so that would be, again, for a longer term trader. If you get in there and it starts to move away, you start to get profitable, raise your stops to break even and let it run. If you're trying to catch a bottom on it. If you want a quick trade, I gave you 8.5%, pop target right there. And then, second, even an intermediate swing target, but it'll just firm up the longer term charts as that bottom of that range. Remember, forever and a day, I've been highlighting this range right here we've been in. And that's it. And we broke below the range. So that's a natural target as well right there. And that would be roughly, give or take, about a 35% run. All righty. What else do I have for you? So I can wrap this up. Wheat. We hit that T2 level again, or T1. Remember, wheat was, we traded it long, short, all year. More wins than losses by far on this one. We were long there, hitting my fourth and final target. Mentioned going short, then mentioned going long again and short. I mentioned both those longs and short of both, but I know I put one as a short pullback trade idea on the site, and that's why there's multiple targets and different time frames I use and different charts, but been very profitable. Then it started just kind of sucking wind. I threw out a few longs. It just couldn't get going here. But as I mentioned, the divergence just keeps growing and growing and growing. And so in the last update, so we're going to diverge it low again. And I maintain these same targets. Back here, we hit it. We hit my first target and we reversed. And we made a slightly new, and I updated at the time. This was based on the futures. And I said, this is still part of this trade. We hit T1. We made ever so slightly a marginal new low, kind of like the stock market right now, but in reverse. That's a marginal new low. That's still a divergent low. And then, boom, went back up, rallied to T1. So again, if I thought, which I obviously did, this was resistance back then by listing it as the first of 5 targets, in the fact we hit it again in reverse, that only makes that level more technically significant. The more reactions you have off a level, the more significant it is. Therefore, 2 things. Number one, if and when we pop, which I expect we will, that should bring in some buyers. Pretty swift move up here to T2 and T3 are right near each other. But I also, I favor that happening. I like it. I like this 60-minute chart. I like the daily chart of wheat. Big positive divergences on the daily. And that's that. Take it, leave it. Oh, but again, as far as timing goes, one of 2 things. Obviously, the next buy signal and the highest probability will be a break over that 607 level, or a little bit, call it 610, the recent highs. But we hit that level, we pulled back. There's some support right here. I keep drawing that squiggly line, but I see some support around right there. I don't know if we're going to get that far. But coming off that divergent low, that puts me usually in buy the pullback mode. So you can buy it here, down to here, and I'd probably have a stop somewhere below there. And then, of course, add if and when that T1 level is taken out. And again, those are your targets. So that's wheat. Bonds, I kind of already covered for you with those trend lines and all that. So I'm going to skip that. Let me go into OJ, and then we'll wrap this thing up. OJ, where do I have here? Okay. So if you recall, this is an obscure little trading vehicle. Unfortunately, there are no ETFs or ETNs, so unless you trade futures, you can't trade this one. I pointed out back here a few months ago, and I gave props to one of the subscribers that pointed it out to me. They pointed out down over here, somewhere in here, because it was going crazy. And I said, I can't make a case to short it, but I'm going to keep an eye on it, and I'll let you know. And then right here, I posted it. So we had this Beautiful parabolic trend line. I always say parabolic trends do not end well. I've never ever seen one that ended well. And we broke it, moved down, had a little snapback, pretty much equaled that high, at least on this chart, the way the scaling is. And we've been moving lower impulsively since. And I think we're probably, there's some support here on 300. I think I have a different target on a different chart I'm going to show you. But max target, and where I think we'll come back to, due to the fact we went in a parabolic run all the way down here to 232, and that would be we're at 363 right now, so a lot of downside potential in orange juice futures, I think. Okay, this is a different variation. This is the uptrend line right here, trend line there, divergent high. Other trend line there that was broken. See, that was that first drop, second leg up. We had a beautiful another secondary uptrend line broken. So if we take out, when those next two trend lines are taken out, 300, 260 and change, and then ultimately 234. Those are my targets. And we'll wrap it up here. I like to cover the big three. I covered bonds earlier, just briefly showed you those uptrend lines. And this is the euro. We've taken out that, I'm crazy about it because I only had a few reactions here and I don't have a clean reaction there. So maybe it would be like that. Remember, I pointed out this bearish rising wedge here. We broke down, hit T1, bounced, hit T2, bounced, hit T3, bounced, slightly undercut T3, kept that divergence very much in place. We're moving here. It all depends on the Fed, guys, where this goes from here. There's been a strong correlation between gold, silver. There always is in the euro. They tend to trade in the same direction. Even the stock market tends to trade in the same direction. But it's Fed day. It's Fed week. There's going to be a lot of noise. I don't want to make any predictions here on this. Other than I still do think there's a good chance we work our way down here to this uptrend line. If that happens, that should be net bearish for stocks. And if that trend line breaks, your next support's all the way down here, about 104.7 right there. And maybe a little flagging action. If I look at it on the daily chart here, we'll see if that plays out or not. I just kind of noticed that potential bear flag pattern, flagpole breakdown would take us down somewhere around there based on the measured target. Okie doke. Let me wrap it up here. Let's see what the Fed does. And more importantly, not what they do. And we know what they're going to do. Let's see what they say. Let's see what Powell says. And then most importantly, how the market reacts to it. Not just today at 2, not today at 2:30 to 3 while he's talking, but more so into the rest of the week and into next week. And like I said,
market data connection
some decent sell signals that have triggered, but they need to play out soon or they're going to be whipsaws. So we'll see where we go there. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.